I've spent my entire career studying market cycles, observing patterns, and trying to understand the fundamental forces that move economies and asset prices. And if there's one thing I've learned over these decades, it's that history doesn't exactly repeat itself, but it sure does rhyme. The year 2022 was one of those years that taught us, or rather reminded us, of lessons that we should have already known. But here's the thing about human nature: we tend to forget. We get comfortable. We assume that what worked yesterday will work tomorrow. And that's precisely when the market teaches us its most expensive lessons. Let me ask you something. Where were you when your portfolio took a hit in 2022? Were you one of those investors sitting there watching your traditional 60-40 portfolio, 60% stocks, 40% bonds melt down like ice cream on a hot summer day? Because that's exactly what happened. The S&P 500 dropped around 19%. Long-term treasury bonds, the so-called safe assets, they crashed about 30%. And cryptocurrencies, they evaporated more than 70%. It was brutal. It was unforgiving. And for many investors, it was completely unexpected. While most portfolios were getting destroyed, while people were panic selling and questioning everything they thought they knew about investing, some specific assets didn't just survive. They thrived. They prospered. This wasn't some random anomaly. This was the predictable result of understanding economic forces, understanding cycles, understanding fundamentals. Because at the end of the day, the market doesn't punish risk. It punishes the risk you didn't understand. Now, I want you to think about this for a moment. 2022 was the year that broke something fundamental. It broke the traditional correlation between stocks and bonds. For decades, investors believed that when stocks go down, bonds go up. That's the whole premise behind the 60-40 portfolio. It's supposed to balance itself out. But in 2022, both stocks and bonds went down together, hard. This exposed something that many people didn't want to see. It exposed the fragility that had been building up over decades of expansionary monetary policy. It reminded all of us why fundamental investment principles matter more than trendy strategies or get-rich-quick schemes. The question I want to pose to you today isn't whether crises like this will happen again. They will. That's a certainty. Economic cycles are as predictable as the seasons. They come and go. Expansion follows contraction follows expansion. What you need to ask yourself is this: will you be prepared when the next one arrives? Because if you truly understand the mechanisms behind what happened in 2022, you'll understand not just how to protect your wealth, but how to position it to actually prosper during the most turbulent periods. History shows us over and over again that the greatest opportunities are born from the greatest crises. But those opportunities only belong to those who understand the forces that move markets. Let me take you back in time for a second. Let's go back to the 1970s. During that turbulent decade, inflation was running rampant, stocks were plummeting, traditional bonds were losing real value at an alarming rate. People were scared, they didn't know what to do. But you know what happened? Some specific assets became true wealth savers. Gold moved from the range of tens of dollars per ounce in the early 70s to more than $800 by 1980. That's not a typo, $800. Energy commodities multiplied in value. Real estate became the perfect hedge against galloping inflation. The pattern was crystal clear. When monetary policy loses control, when inflation erodes purchasing power, when confidence in fiat currencies begins to waver, markets instinctively turn to real, tangible, scarce assets. This isn't new. This isn't revolutionary. This is a pattern that's been repeating itself for centuries. And if you stick with me here, you'll see how understanding this pattern could change everything about how you think about investing and protecting your wealth. Fast forward to the European sovereign debt crisis of 2010 to 2012. While bonds from countries like Greece, Spain, and Portugal were collapsing, the US dollar strengthened dramatically. US Treasury bonds became the global safe haven. Gold reached historic highs. The same patterns emerged. Whenever confidence in the financial system gets shaken, whenever inflation accelerates, whenever monetary policies become unsustainable, we see these same patterns play out. It's like watching the same movie with different actors. So 2022 was no exception. It was confirmation. The difference is that many investors, maybe even you, had forgotten these lessons, and I get it. Decades of low interest rates, quantitative easing, this whole "there is no alternative" mantra, it created an entire generation of investors who had never experienced a true inflationary crisis. They learned the hard way that fundamentals never go out of style. They never become obsolete. They're the bedrock of successful investing. Now let me share something with you that I think is absolutely crucial. To understand why certain assets prospered in 2022 while others vanished, we need to understand three fundamental principles that govern all financial markets. Think of these as the rules of the game. And once you understand the rules, you can play the game much more effectively. The first principle is understanding the nature of monetary cycles. Every monetary system, every economy goes through predictable cycles: expansion, growth, exuberance, excess, correction, and contraction. During the expansionary phase, which we lived through from 2009 to 2021, cheap money flows into risk assets. Stocks rise, bonds rise. Even speculative assets like cryptocurrencies experience these extraordinary bubbles. Everyone feels like a genius. Everyone's making money. But when the cycle turns, and trust me, it always turns, when central banks are forced to fight inflation by raising interest rates dramatically, liquidity evaporates. Money flees from risk assets and desperately seeks safety, real returns, and protection against monetary debasement. This is mechanical. It's a mathematical consequence of the nature of money and credit. The second principle is understanding the relationship between inflation and asset allocation. Inflation is fundamentally a monetary phenomenon. When central banks print money in excess, when governments spend beyond their capacity, when the financial system becomes excessively leveraged, inflation becomes inevitable. It's not a matter of if, it's a matter of when. And when inflation accelerates, the entire asset hierarchy changes. Financial assets, especially those with long duration like 30-year bonds, become extremely vulnerable. Their fixed cash flows get eroded by declining purchasing power. Meanwhile, real assets, commodities, energy, scarce materials, these become the true stores of value. They don't just maintain purchasing power, they actually benefit directly from monetary debasement. The third principle, and this is where most people get it wrong, is understanding the importance of true diversification. Most people think they're diversified when they own 60% stocks and 40% bonds. But let me be blunt with you. That's not true diversification. That's concentration in financial assets denominated in the same currency, exposed to the same economic forces, vulnerable to the same risks. True diversification means owning assets that respond differently to the same economic forces. It means having exposure to different currencies, different geographies, different asset classes, different time horizons. When you understand that correlations between assets can change drastically during periods of stress, you realize why concentration is the silent enemy of long-term wealth preservation. Let me paint you a picture. Imagine two American families at the beginning of 2022. Both have similar wealth. Both are concerned about retirement. Both are following what appear to be sensible strategies. The first family, let's call them the Johnsons, they followed the traditional 60-40 portfolio. 60% in the S&P 500 index through index funds, 40% in long-term treasury bonds. This is the strategy that's been recommended for decades by traditional financial advisors. It's comfortable, it's familiar, it's what everyone does. The second family, the Rodriguez family, they base their portfolio on understanding economic cycles. 25% in stocks, but diversified globally and across sectors. 15% in short-term bonds with low duration risk. 20% in commodities that benefit from inflation. 15% in dollars through certificates of deposit and money market funds. 15% in infrastructure and real estate funds that can pass through inflation. 10% in physical gold as insurance. Now, and this is important, these are educational examples, not investment recommendations. But the principle is what matters here. The result at the end of 2022, it was devastating for the Johnsons and revealing for the Rodriguez family. The S&P 500 fell approximately 19%. Long-term bonds plummeted around 30%. The Johnsons' traditional 60-40 portfolio lost about 23%. One of the worst performances in decades. And remember, This is their retirement savings. This is their life's work. This is what they were counting on to fund their golden years. Meanwhile, the Rodriguez's diversified portfolio didn't just resist the storm, it prospered. Commodities rose approximately 16%. The dollar appreciated around 8%. Energy soared more than 40%. Gold remained stable as a store of value, doing exactly what it's supposed to do during uncertain times. The difference between these two families wasn't luck, it wasn't insider information, it wasn't having a crystal ball, it was understanding fundamentals. The Johnsons followed conventional wisdom. The Rodriguez family followed the wisdom of cycles. Now, I want to talk about something that hits close to home for many of you watching this. For the average American who's concerned about retirement and wealth protection, the lessons of 2022 are crystal clear and immediately applicable. If you were 55 years old in 2022 and planning to retire at 65, a 23% loss in your portfolio meant something very real. It meant potentially delaying retirement by 2 to 3 years. It meant drastically reducing your standard of living. It meant working longer than you wanted to. For every $100,000 invested traditionally, you lost $23,000 that would take years, maybe even a decade, to recover. That's not just a number. That's your life. That's your freedom. That's your time. But if you had diversified following an understanding of cycles, you not only maintained your retirement timeline, you possibly faced much smaller losses or even accelerated your retirement plans. The 2022 inflation eroded approximately 8% of purchasing power. This means your $100,000 in cash was effectively worth $92,000 at the end of the year. But those who owned commodities didn't just maintain purchasing power, they expanded it. Every dollar in energy appreciated 40%. Every dollar in basic materials maintained its real value. Think about what that means. Families that depended on fixed income from bonds saw their real yields become negative. They were losing money in real terms, even though their account statements showed numbers that looked okay. Retirees living off stock dividends saw their portfolios plummet. But families that owned infrastructure real estate funds received growing dividends. Those with dollar exposure saw their savings earn more in money market funds and certificates of deposit. The difference between losing 23% and protecting your wealth in 1 year isn't just statistical. For a family with $500,000 in savings, it represents the difference between losing $115,000 and keeping most of their wealth intact. This difference is enough to completely change a family's financial trajectory. It's the difference between comfort and stress, between security and anxiety. So let me get specific about what actually worked in 2022. Because understanding what worked, and more importantly why it worked, that's where the real value is. 4 categories of assets had relatively better performance or protected capital, while the traditional 60-40 portfolio was getting beaten up. If you had inflation protection, short-term duration, dollar exposure, and energy, you could breathe, you could sleep at night. The first asset class that absolutely crushed it was energy. The energy sector was the undisputed winner of 2022. Energy ETFs rose around 65% during the year, while the general market was collapsing. Why did this happen? Multiple factors converged. The war in Ukraine created supply shocks. Environmental policies had reduced investment in fossil fuels for years, creating supply constraints. Resilient demand combined with restricted supply. And inflation directly benefited energy prices. But beyond these situational factors, there's structural logic here. Energy is a fundamental input for every modern economy. When its supply is restricted and demand is inelastic, prices soar. It's Economics 101. Companies like Exxon, Chevron, ConocoPhillips, they didn't just see their stocks multiply in value. They generated extraordinary cash flows that enabled robust dividends and massive share buybacks. If you owned energy, you were having a very different year than everyone else. The second asset was the US dollar. The dollar index rose approximately 8% in 2022, reaching levels not seen in decades. During global crises, the dollar benefits from 3 powerful forces. First, flight to safety. When global markets panic, capital flows to U.S. assets like water flowing downhill. Second, Interest rate differentials. The Fed was raising rates more aggressively than other central banks, making dollar-denominated assets more attractive. Third, economic resilience. The U.S. economy was showing relative strength compared to Europe and Asia. For Americans, this meant that certificates of deposit in dollars, money market funds, and short-term treasury bills offered not just safety but also growing yield as the Fed kept raising rates. Cash stopped being trash and started being king again. The third asset class was short-term treasury bills. While long-term bonds were getting obliterated, 3 to 6 month treasury bills became some of the most attractive assets in the market. As the Fed raised rates from near zero to more than 4%, short-term bills offered something beautiful: principal protection with very low duration risk, automatically growing yield, total liquidity, zero credit risk. A 6-month certificate of deposit that paid 0.5% at the beginning of 2022 was paying more than 4% at the end of the year. That's an 8-fold increase in yield, while longer duration assets were being destroyed by rising rates. This is why understanding duration matters. 2S. The fourth asset category was essential infrastructure and businesses with long-term contracts. These assets had relative resilience in 2022 because of their unique characteristics. They have regulated or contracted revenue streams. They have the ability to pass inflation through tariff increases. They provide essential services with inelastic demand, and their dividend yields can adjust with inflation. In practice, this includes regulated infrastructure, utility companies, concessions, and business models with adjustable contracts. These tend to hold up better when inflation pressures costs and when the economy slows down. Their dividend yields became more attractive relative to treasury yields, and their revenue streams with built-in indexation offered partial protection against rising prices. Now, while these four categories held up well or thrived, one specific category experienced one of the most violent crashes in financial history: long-term treasury bonds. These supposedly safe assets lost around 31% in 2022. One of the worst performances in history. Why were long-term bonds so devastated? Let me break this down because it's crucial to understand. First, extreme duration risk. 20 to 30-year bonds have a duration of approximately 18 to 20. This means that for every 1% increase in yields, the bond price falls 18 to 20%. When 10-year Treasury yields rose from 1.5% to more than 4% during 2022, long-term bonds experienced relentless mathematical destruction. Second, inflation eroding real value. Even if yields hadn't risen, 0% inflation made any fixed-rate instrument paying 2 or 3% a losing proposition in real terms. A bond paying 2% annually in an 8% inflation environment results in a negative 6% real return. Investors couldn't and wouldn't accept this math for long. Third, the Fed's policy was working directly against bondholders. For the first time in decades, the Fed was aggressively tightening monetary policy. Each Fed meeting brought the possibility of more rate hikes, continuously pushing yields up and bond prices down. Fourth, institutional selling pressure. Pension funds, insurance companies, foreign central banks, institutions that traditionally buy long-term bonds, they were either selling or avoiding new purchases, creating sustained downward pressure on prices. The result was devastating for those concentrated in long-term fixed income. Retirement portfolios heavy in target date funds with significant duration exposure saw decades of gains evaporating in months. Retirees who thought treasury bonds were safe learned a painful and expensive lesson about different types of risk. Credit risk was indeed zero. The U.S. government wasn't going to default. But duration risk and inflation risk, they were devastating. The cruel irony is that many investors fled risky assets like stocks at the beginning of 2022 to buy safe treasury bonds, only to experience larger losses in their supposedly safe investments. This is what happens when you don't understand the different types of risk. Now, if you're watching this and you're thinking, okay, this is interesting history, but what does it mean for me going forward? That's exactly the right question to ask. Because understanding 2022 isn't about looking backward, it's about preparing for what's coming next. The relevant question isn't whether another cycle like this will happen. History tells us it absolutely will. The question is when, and more importantly, how will you be positioned when it does? Federal Reserve policy continues to be the main driver of these asset allocation cycles. When the Fed shifts from accommodative to restrictive monetary policy, the same patterns tend to emerge over and over again. You need to watch for certain signals. Yield curve movements indicate monetary policy direction. Inflation expectations and break-even rates signal future pressures. Dollar strength relative to other major currencies shows where capital is flowing. Credit spreads widening in corporate bonds indicate growing stress in the system. Commodity prices reflect supply and demand imbalances. These aren't precise timing indicators. Nobody can time the market perfectly, and anyone who tells you they can is either lying or delusional. But these are guides for structural changes that develop over months and years, not days or weeks. I want to introduce you to a concept that I think is incredibly powerful. It's called anti-fragility. This isn't just about surviving shocks. It's about building portfolios that can actually benefit from them. Anti-fragile portfolios share certain common characteristics. They have multiple sources of return that are uncorrelated with traditional assets. They have exposure to assets that actually benefit from volatility and uncertainty. They have embedded optionality through asymmetric payoffs, and they have low correlation with the standard 60-40 allocation that most people use. This doesn't mean speculation. It doesn't mean gambling. It doesn't mean putting all your money in crypto or meme stocks or whatever the latest craze is. It means careful, thoughtful construction of portfolios that can prosper in different economic environments. Because here's the reality. Market environments change. The rules of the game shift. And portfolios need the capacity to adapt. This means regular rebalancing based on changing fundamentals. It means having the willingness to increase or decrease exposure based on systematic analysis of cycles. It means maintaining some liquid assets to take advantage of opportunities when they arise. And it means avoiding concentration in any single theme or sector, no matter how attractive it looks right now. Now, flexibility doesn't mean constant trading. Day trading is not what I'm talking about here. Flexibility means thoughtful adjustment based on systematic analysis of changing conditions. It means having a framework, having principles, but not being rigid to the point where you can't adapt when the environment shifts, because it will shift. That's the only guarantee in markets. Let me get practical for a moment. If you're in that critical age range, let's say between 50 and 65 years old, you have unique needs. You need to protect the wealth you've accumulated over decades while still maintaining some growth potential. You can't afford to take massive risks, but you also can't afford to be so conservative that inflation eats away at your purchasing power. You're in this delicate balance. An educational allocation structure might look something like this: 30% in growth assets with diversified equity exposure. Not just U.S. stocks, but global diversification across sectors and geographies. 30% in real assets like commodities, real estate funds, infrastructure investments. 25% in fixed income, but with duration varying based on where we are in the interest rate cycle. And 15% in alternatives like precious metals, currency exposure, inflation-protected securities. The main consideration here is reducing what we call sequence of returns, risk. This is the risk that you'll experience poor returns right when you're about to retire or right after you retire, which can devastate your long-term financial security. But you also need to maintain inflation protection because retirement might last 20, 30, or even 40 years. Inflation compounds over time. And if you're not protected against it, your purchasing power will erode slowly but surely. For those who are recently retired between 65 and 75 years old, the primary focus shifts to income generation and principal preservation. But and this is critical, you still need to recognize that retirement may last 20 to 30 years or more. You can't just put everything in cash and call it a day. A suggested educational allocation might be 20% in dividend-focused growth assets, 35% in income-generating assets like bond ladders and dividend-paying real estate funds, 25% in principal protection through certificates of deposit, treasury bills, money market funds, 20% in inflation protection, like Treasury inflation, protected securities, commodities, precious metals. The emphasis here is on assets that provide stable income streams while still protecting against the silent killer, which is inflation eroding your purchasing power over time. For established retirees 75 years and older, capital preservation becomes absolutely fundamental. But even here, complete risk avoidance can lead to purchasing power erosion. A conservative allocation example might be 10% in growth assets like high-quality dividend stocks, 40% in short to medium duration fixed income, 35% in guaranteed principal through government-insured deposits and Treasury securities, 15% in inflation protection with Treasury inflation-protected securities, and perhaps some commodity exposure. The focus is on maintaining purchasing power while minimizing volatility, because at this stage, you don't have time to recover from major losses. Now, I want to emphasize something really important here. All of these examples I've shared are for educational purposes. They are not investment recommendations. Your specific situation is unique. Your risk tolerance, your time horizon, your income needs, your tax situation, all of these factors matter. What I'm trying to give you is a framework for thinking, not a cookie-cutter solution that works for everyone. Here's something that 2022 taught us that I think is absolutely crucial. Traditional diversification failed because correlations between asset classes increased dramatically during stress periods. When everything's going well, stocks and bonds might move independently. But when the crisis hits, when fear takes over, correlations spike. Everything starts moving together. That's when you find out whether you're truly diversified or just think you're diversified. Effective risk management requires a deeper understanding of how different risks interact with each other. Duration risk became the primary concern in 2022. Managing this requires laddering fixed income investments across different maturities, using floating rate instruments that automatically adjust with changing rates, understanding that principal risk and reinvestment risk move in opposite directions, and recognizing that interest rate environments can persist for years, not just months. Inflation risk is something that erodes purchasing power gradually but persistently. It's like termites eating away at the foundation of your house. You don't see it happening day to day, but over years the damage becomes catastrophic. Protection against inflation requires assets that historically outpace inflation over time. Automatic adjustment mechanisms like Treasury inflation, protected securities, and floating rate bonds. Real assets that benefit directly from inflation, like commodities and real estate. Income streams that can increase with rising prices. For Americans, currency risk often goes completely unrecognized until international investments decline due to dollar strength, and then people wonder what happened. Effective currency management includes understanding when dollar strength and weakness cycles typically occur, considering international investments with currency hedging during certain periods, recognizing that domestic assets benefit from dollar strength, and maintaining some international exposure for long-term diversification, because no single currency dominates forever. 2022 also demonstrated that liquidity can disappear rapidly in certain market segments. When everyone's trying to sell at the same time, buyers vanish. Managing liquidity risk involves maintaining emergency reserves in highly liquid accounts, avoiding concentration in illiquid investments that you can't exit quickly if you need to, understanding that liquidity premiums, the extra return you get for holding illiquid assets, these change dramatically based on market conditions, and having access to liquid assets during emergency situations so you're not forced to sell at the worst possible time. But here's something that doesn't get talked about enough. All of these technical analysis tools, all of these rational allocation strategies, they're only effective if you can actually execute them during stressful periods. 2022 severely tested investor psychology. Common behavioral errors were everywhere. Panic selling at market lows when fear was at its peak. Paralysis when rebalancing would have been most beneficial. Chasing performance in assets that had already made large moves, buying high instead of buying low, abandoning long-term strategies based on short-term volatility. Successful investors develop psychological frameworks that help them navigate these difficult periods. This includes truly understanding and accepting that volatility is normal and expected. It's not an aberration. It's a feature of markets, not a bug. Focusing on long-term goals rather than short-term fluctuations. Having predetermined rules for rebalancing and adjustment so you're not making emotional decisions in the heat of the moment. And maintaining perspective on historical context. Remembering that we've been through crises before and markets have always recovered, even when it felt like they never would. Emotional decision-making during crisis periods almost always, and I mean almost always, destroys long-term returns. This is why systematic approaches are so valuable. They help by removing emotion from rebalancing decisions. They provide clear guidelines for when to make adjustments. They create accountability through written investment policies. And they establish regular review periods that are independent of market conditions. You're following a plan. Now, historical analysis provides incredibly valuable insights. But and this is important, each cycle has unique characteristics that require adaptation. You can't just apply the lessons of the 1970s directly to today. The world has changed. Technology has changed. Work. The financial system has changed. But certain fundamentals persist through different market environments. Asset prices ultimately reflect underlying fundamentals. Diversification reduces but doesn't eliminate risk. Inflation erodes the purchasing power of fixed value assets. Cycles of expansion and contraction are inevitable parts of economic systems. These truths are eternal. But each crisis also teaches new lessons because underlying conditions evolve. Monetary policy tools and their effectiveness change over time. Global trade relationships and dependencies shift. Technological disruptions and their economic impacts continue to evolve. Demographic changes affect demand patterns in ways that are sometimes predictable and sometimes surprising. Effective investment strategies need to evolve while maintaining these core fundamentals. This means staying informed about changing regulatory environments. Understanding how new asset classes fit into traditional frameworks, recognizing when historical relationships no longer apply, and maintaining flexibility to adapt to new conditions as they emerge. If you've carefully observed the lessons of 2022, if you've really absorbed what happened and why it happened, you'll begin to see that this isn't simply about four assets that went up and one that got crushed. It's about something much more fundamental. It's about understanding that we live in a world of cycles. The same economic forces reappear in different forms, but following predictable patterns. It's like music. The melody changes, but the underlying harmony follows certain rules. The difference between preserving wealth and losing it during turbulent periods isn't about having the ability to predict the future. Nobody can do that consistently. It's about understanding the rules that govern how markets respond to changing conditions. 2022 taught us, or reminded us, that traditional asset allocation, this familiar 60-40 split between stocks and bonds, was built for a specific world. A world of declining interest rates and benign inflation. When that world ended, when the conditions changed, many investors discovered that their strategies were completely inadequate for the new reality. But those who understood cycles, who recognized the signs of changing monetary policy, who diversified beyond traditional categories, they didn't just survive, they prospered. They slept better at night. They maintained their retirement timelines. They preserved their purchasing power. True wisdom in investing isn't about trying to time markets. It's about building portfolios that can prosper in different environments. Portfolios that recognize correlations between assets change during stress periods. Portfolios that understand protection often comes from assets that seem unconventional or even uncomfortable during calm times. Every crisis, and I mean every single crisis, contains within it the seeds of both destruction and opportunity. The Chinese character for crisis is made up of two symbols, danger and opportunity. This isn't just a clever saying, it's a fundamental truth about markets and life. The difference between experiencing destruction or opportunity depends entirely on preparation, understanding, and discipline. You need all three. Preparation without understanding leads to rigid strategies that break when conditions change. Understanding without discipline leads to knowing what to do but not doing it. Discipline without preparation and understanding leads to following rules that don't apply to the current situation. History doesn't repeat exactly, the specifics change, but it rhymes, the patterns echo. These rhythms, the cycles of debt and deleveraging, of inflation and deflation, of monetary expansion and contraction, these provide maps for navigating uncertainty. They're not perfect maps. They don't show you every detail, but they show you the general terrain. They help you understand where you are and where you might be heading. Because ultimately, successful investing isn't about avoiding all risks. That's impossible. If you try to avoid all risk, you end up taking the biggest risk of all, which is the risk of not achieving your financial goals. Successful investing is about understanding risks, preparing for them, positioning yourself to benefit when others are caught unprepared. It's about being the person who can buy when everyone else is panic selling, being the person who can stay calm when everyone else is losing their minds. The lesson of 2022 isn't that certain assets always win during crisis. Energy won't always be the winner. Bonds won't always be the loser. The specific outcomes change based on the specific circumstances. What matters is understanding why they won or lost, the fundamental forces that drove their performance. This understanding provides a framework for making better decisions in future cycles. And this framework, built on understanding economic principles rather than speculation about specific outcomes, this is what separates temporary profits from long-term wealth preservation. If you can embrace uncertainty as a constant rather than seeking false comfort in predictions, if you can accept that nobody knows exactly what's going to happen next, you develop the capacity to prosper regardless of what markets bring. Because you're not betting on one specific outcome, you're prepared for multiple scenarios. You have options, you have flexibility, you have resilience. In the end, markets will continue to cycle. Policies will change. Crises will emerge, sometimes from directions we didn't expect. Opportunities will appear, often disguised as problems. The question isn't whether you'll face another environment like 2022. You will. The question is whether you'll be prepared when it arrives. The answer to that question depends entirely on choices you make today, whether you choose to understand the rules of the game or merely chase performance, whether you build anti-fragile portfolios or expect traditional approaches to work forever, whether you embrace the complexity of reality or seek comfort in oversimplified strategies that sound good but don't work when it matters most. 2022 was a test. For some investors, it was absolutely devastating. Their retirement plans were derailed. Their financial security was compromised. Their confidence was shattered. For others, it was confirmation that the principles work, that preparation pays off, that understanding cycles provides a sustainable competitive advantage. In 2022, having inflation protection, short-duration bonds, dollar exposure, and energy wasn't a luxury. It was oxygen. It was the difference between financial suffocation and breathing freely. So I want to leave you with this. Choose your path accordingly. Choose whether you're going to be reactive or proactive, whether you're going to be a victim of circumstances or someone who navigates them successfully. History is incredibly generous with its lessons. The information is all there. The patterns are visible. The principles are clear. But these lessons, these insights, they're only valuable for those wise enough to learn them, for those humble enough to accept that markets can teach us, for those disciplined enough to apply what they learn even when it's uncomfortable. The market doesn't punish risk. Let me say that again because it's so important. The market doesn't punish risk. It punishes the risk you didn't understand. It punishes overconfidence. It punishes rigidity. It punishes the assumption that tomorrow will be like yesterday. The investors who prospered in 2022 weren't the ones with no risk. They were the ones who understood their risks, who prepared for multiple scenarios, who had the knowledge and the courage to position themselves differently from the crowd. If this way of thinking resonates with you, if you found value in understanding these patterns and principles, I'd encourage you to explore these ideas further, not just for a day or a week, but as an ongoing process of learning and adaptation. Because the markets are always teaching, the cycles are always turning, the opportunities are always emerging for those who know how to see them. Stay curious, stay humble, stay prepared. That's the path to long-term wealth preservation and growth in a world of constant change and uncertainty. Thank you for your time and attention. I hope this perspective serves you well in your financial journey. Well, my